Could choosing the wrong investment fund cost you your future financial security? Imagine standing at a crossroads, the path you choose veiled in the early morning mist. One road leads to index funds, another to mutual funds, and a third to ETFs. Each path winds into the horizon, representing a unique journey through the financial landscape. Overlooking the fees could slow your journey and eat away at your fortune. How consistency can be more valuable than anything. The most important factors to look into whether they're mutual funds or index funds. Remember, are you getting value for the price or watching your future slip away? Let me show you. Imagine slowly leaking money without even noticing. That's what high fees do in the investment world. Let's dive into the stark realities of how fees can gnaw at your investments, using some real-world examples. Take the Fidelity Zero Total Market Index Fund, or FZROX, boasting an expense ratio of 0%. Starting out with $10,000 in this fund could have grown to over $22,000 over time, thanks to its absence of fees. Contrast this with funds that carry higher expense ratios like VOO, with an expense ratio of 0.03%, or SPY at 0.09%. Even a seemingly small difference, like from 0.00% to 0.9%, can translate into a significant financial divergence over decades. This variance can mean a difference of hundreds of thousands, between capturing a fortune and merely doing okay. Imagine every year a tiny slice of your investment pie, no matter how small, being shaved off. Over 20-30 years, that slice becomes a substantial portion. Every fraction of a percent in fees devours your future gains, no matter if they are index funds or mutual funds. In the throes of market turmoil, a single emotional decision can derail a lifetime of planning. Imagine an investor, let's call him Tom. Tom has been diligently investing in index funds with a buy-and-hold strategy, aiming for the long haul. But then, the market takes a sharp downturn. Fear grips Tom, and in a moment of panic, he sells his holdings, trying to cut his losses. This decision, driven by short-term emotions, locks in Tom's losses, turning a paper loss into a real one. Contrast this with another investor, Lucy, who, despite the same market conditions, decides to hold her ground. She understands that index funds are a marathon, not a sprint. Over time, the market recovers, and Lucy not only regains her initial losses, but also enjoys substantial gains as she dollar-cost averaged into the downturn and back out. The lesson? Emotional investing can be perilous. It's akin to abandoning ship in a storm instead of navigating through it. When the market storms hit, no matter if you have index funds or mutual funds, will you anchor your ship or be swept away by panic? This leads into the next point. Neglecting regular investments is like refusing to water a plant. How can you expect it to grow? In the world of investing, the art of reinvestment and consistent contributions cannot be overstated. It's akin to nurturing a garden. Each dividend reinvested and every consistent contribution is like watering and fertilizing the soil, setting the stage for flourishing growth over time. For example, consider the impact of reinvesting dividends from a robust index fund. This strategy harnesses the power of compounding, where earnings generate their own earnings, exponentially increasing the growth potential of your investment. Take the Fidelity Zero Total Market Index Fund. With an initial investment and regular contributions, an investor could see their portfolio's value significantly enhanced over the years. Neglecting to reinvest those dividends or skipping regular contributions is akin to halting the watering process. The result? A stunted financial tree struggling to reach its full potential. Consistency is the secret ingredient to your investment's growth. Don't starve it of what it needs to thrive. Now, let's put our contenders to the test. Which fund will emerge as the champion of growth and stability with these principles in mind? In the left corner, we have FZROX, the Fidelity Zero Total Market Index Fund. With an expense ratio that whispers an almost silent 0%. It's like a stealthy ninja in the world of investments. Starting with $10,000, FZROX has grown to $22,398. Imagine that, a 16.05% compounded annual growth rate amidst a tumultuous market with a best year surge of 31.15% and a worst year drop of minus 19.19%. The resilience here is nothing short of legendary. Next, enter FTEC, the Fidelity MSCI Information Technology Index ETF, sporting a slightly higher expense ratio of 0.08%. From $10,000, it soared to a staggering $33,805. With a best year of 53.3%, it's like a rocket in your portfolio. Yet, the drop of minus 29.59% in its worst year reminds us of the volatile dance of technology stocks. Here comes SMH, the VanEck Vectors Semiconductor ETF. Don't be fooled by the higher expense ratio of 0.35%. This fund skyrocketed to $57,620. With an electrifying best year at 73.37%, it shows the high stakes of semiconductor investing, though a fall of minus 33.52% in its worst year could send shivers down any investor's spine. Last, but certainly not least, the Fidelity 500 Index Fund steps up. With an ultra-low expense ratio of 0.015%, it turned $10,000 into $23,050. It mirrors the steady heartbeat of the S&P 500, with a maximum drawdown less severe than its peers, highlighting its defensive prowess in the market arena. As we've seen, each fund carries its own sword and shield. The right choice depends on how well these weapons match your battle strategy. The stakes are high and your future is on the line. How will you decide? In the battle of investments, whether it's the low-cost allure of index funds like FZROX, the tech-driven heights of ETFs like FTEC, or the steady climb of mutual funds such as the Fidelity 500, each choice carries its weight with different expense ratios accompanying the higher returns. Remember, ignoring fees can devour your returns, emotional decisions may sabotage your growth, and neglecting reinvestment could stall your financial ascent. Whether you have index funds or mutual funds, the difference is the consistent value you get for the price, in addition to your own discipline. In the arena of investment, the wise warrior chooses their arsenal with care. May your choices lead you to prosperity. Subscribe and comment on if there are any other funds or financial topics you would like me to talk about.